why is fire insurance so difficult to obtain, and how does that affect buyers who are looking to purchase a home in a fire zone? Stay tuned. Scott Himelstein with the Scott Himelstein Group. So right now, if you're trying to buy a home in a fire hazard area such as Porter Ranch, Chatsworth, maybe Granada Hills, Santa Clarita, areas of Agoura, Calabasas, etc. here in Southern California, well, you probably have some sticker shock because it's not uncommon for homeowners insurance policies to actually right now cost for the entire year one policy $10,000 to $15,000. So what's the reason behind that? So as insurance companies continue to limit or coverage or leave California, it can be really overwhelming for consumers to keep track of the available insurance options. So we're going to discuss a little bit about that today. So you might have heard over the course of the last several months, you have had several insurance companies either stop issuing policies here in California or leaving the state altogether. So what does that mean for you as the consumer? Well, insurance companies, they need to remain profitable enough to be able to comply with state law and to pay out the claims of their existing customers. But this has really proven to be a lot more difficult over the course of the last few years due to recent wildfire losses and other factors. So let's take a moment here to really understand the challenges. So for California, the home insurance market faces a number of challenges, making it increasingly difficult for homeowners to secure coverage. So these challenges include the recent wildfire losses. You have to go back to 2017 and 2018, where California insurers paid out a staggering $15.4 billion and $13.6 billion in losses, respectively, due to the unprecedented wildfires. So this marked a significant increase in the annual losses compared to previous years. So consequently, the insurance carriers, they sought rate increases to offset the losses, and this resulted in higher premiums for homeowners. So rating and underwriting regulations from Proposition 103, and that was a law enacted in 1988, which requires insurance companies to justify rate increase requests based on their average annual wildfire losses over the past 20 years. And with the exponential rise in wildfire losses, insurance companies are forced to take on more risk than they can adequately compensate through their premiums. And consequently, many of these insurance companies have pulled back from high-risk areas or left the state altogether. And then you have inflation and supply chain issues. So residential construction costs have surged by approximately 34% since the beginning of the pandemic due to supply chain disruptions and labor shortages. So for insurance carriers, higher rebuild costs have led to increased claim payments and loss ratios on the homeowner's side. And so the inflation has resulted in many people actually being underinsured as the cost to rebuild their homes after a disaster has risen significantly. So while there's no clear timeline for when California's insurance market is going to actually stabilize, homeowners can take some steps to actually ensure their homes and finances are actually adequately protected. So the first one is the obvious one, is to contact your insurer. So if your insurance policy is canceled or not renewed, reach out to your insurance agent to explore options to mitigate your home's risk and maintain your policy. So that includes maybe fireproofing your home, taking measures to reduce your home's wildfire risk. Not only makes it more appealing to insurance carriers, but also qualifies you for premium discounts. So programs like the Wildfire Prepared Home Initiative offer fireproofing designations for fire-resistant roofing and creating defensible spaces around your home. The second one is consult a local insurance agent. So given the restrictions placed by some insurance companies on the type of actual policies they're actually able to issue. So it makes sense that you're going to want to have somebody local on the ground. Consider contacting a local insurance agent familiar with all the unique opportunities and options in the insurance landscape. So the Department of Insurance offers a tool to actually be able to find insurance in your area. And the big one is consider the California Fair Plan. And that's like the house right behind me right here with this buyer, which we recently closed on, actually ended up using. So nobody else is willing to offer insurance on the home. And so the California Fair Plan serves as a state's insurance program, kind of last resort for homeowners who were denied coverage in the voluntary market. And while it can be a suitable short-term gain and opportunity to use as an option, it may be pricier, and a lot of times it offers a lot more limited coverage than usual standard policies. So while we're seeing challenges in the California home insurance market, a lot of these things can actually help you be able to navigate that, but it's important to be aware of because a lot of people are really finding sticker shock, and especially if you're a buyer, if you have to actually qualify for that $10,000 to $15,000 annual policy, that's going to count against your debt ratio as opposed to maybe $1,500 to $2,000. So any questions about the home insurance market as well as real estate, give me a call, 818-396-3311, 818-396-3311, and thanks for watching our vlog.